We are continuing our session of this afternoon. Buenas tardes, Dr. Spiller.
Good afternoon, Mr. Spiller. I'm going to ask you to please... How are you? I'm fine. Could you please read the statement that you have before you, the witness statement?
I solemnly declare upon my honor and conscience that my statement will be in accordance with my sincere belief.
Thank you. Mr. de Bovois.
Thank you, Mr. President. Good afternoon, Dr. Spiller. Dr. Spiller, do you have before you the two expert reports you have submitted in this case? And do you ratify them and confirm that the opinions you express therein represent your objective and independent professional opinion?
Yes, these are my reports.
Dr. Spiller, are your professional qualifications for the assignment you were given set forth in Exhibit LECG01 attached to your report containing your curriculum, publications, and major presentations in conferences and seminars?
Well, it's not attached here. Let's see. It's not attached here, but that's, I believe that's what it is.
Okay, thank you. Please describe, Dr. Spiller, for the tribunal, your understanding of the exercise you were asked to undertake.
Yes, I was asked to provide my independent opinion on claimants' experts' damage assessment.
Dr. Spiller, the tribunal has before it reports from Mr. McSwain, Dr. Pratt, and Mr. Thompson, experts presented by the claimants, as well as two reports from you. Would you please tell the tribunal what the major differences are between the two sets of reports?
Okay, let me provide you with the next with a slide.
Excuse me. I apologize for objecting, but these slides were just provided to us. We would have been happy to check them. We provided slides that we planned on using last night so that they could check to make sure they were consistent with the evidence. I'm seeing them for the first time. I have absolutely no ability to check these slides, and we object to their use.
Mr. Foster, I think you should wait until you see the slides. I think you'll see the numbers are very familiar.
I don't have any idea. Don't have time to check them. And it's simply, if you had supplied them to me last night, I would have been happy to look at them and determine whether or not we could do this without objection. You chose not to do that. I object.
Mr. Foster, I certainly wasn't going to give them before your experts had testified.
We gave you slides before your experts testified. This just isn't the way we do things.
They're all based on record evidence.
This slide's part of the record.
These are all based on record evidence, Mr. President. There's nothing new and invented here.
But the slides themselves are not on the record.
Slides themselves are not on the record, but every single number that appears in them is in the record.
Okay.
And they're not submitted as evidence themselves. They're demonstrative to help the tribunal understand the numbers that have been presented to them.
what the tribunal proposes is that we have a brief recess, that you check the slides. There are 6 slides, and if the figures are all on the record, I mean, it's something that, and you tell us how long you need. I mean, can I make a suggestion?
If we're going to do this, I mean, I think that, Mr. Devois, you should supply to all of us where in the record each of these figures is shown so that we can verify that they're substantiated by other parts of the record.
I think you'll see that the first slide comes from Mr. Spiller's second report, Table 3.
So it's just a copy of the same report?
It's the same data from those reports, yes.
The data, but not the slides.
I don't have any idea how long it would take for us to check these. Our experts have gone back, have left. The problem is, if heretofore the rules have been that if you have something that you're going to present, you present it to the other side, and for some strange reason the rules seem to change now.
Tribunal will sustain the objection. If it's something that cannot be done briefly, and we were looking at it, and probably that's correct, that it cannot be done just quickly enough.
Dr. Spiller, could I ask you please to explain the major differences between the damages assessments, in particular also by reference to figure number 1 on page 16 of your second report? You may start with the major differences and go from there.
Mr. Spiller? Mr. Spiller? The microphone.
There are 4 fundamental differences, and if I may point the tribunal to Table 3 in the second report in page 51. In Table 3 of page 51, there is the reconciliation between claimant's experts and my assessment of damages. In this Table 3, you will see that claimant's experts assess damages assess the fair market value and damages essentially at $63.8 million of December 2006, while I assess it at negative $2.715 million. Now, in this table, I provide various items that reconcile the difference, but fundamentally, there are 4. The first one is the double counting. As I provide in my first and second report, claimants' experts double count damages because to the fair market value, their own assessment of the fair market value of Ferrovias, they add to that what they call the lost investments of RDC in Ferrovias. Now, that in Table 3, essentially you have this 44 minus 44,294, which is I cannot use this math, but in principle will be in this first line of the second part of the second part of that table. Now, this 44 is netted out later on by 7.8 and other numbers. But the moment you take away that double counting, a substantial portion of the difference, more than half of the difference, disappear between claimants, experts, and me. The second large component of difference is that damages are assessed by Mr. Thompson based on the real estate assessment of Mr. McSwain. In my opinion, Mr. McSwain has substantial amount of unsubstantiated real estate revenues. And in this table, you can see that I assessed these unsubstantiated revenues at approximately $27 million. So in between the double counting and the double counting of losses and the overstatement of real estate revenues, you have essentially most of the difference between Mr. Thompson and me. There are two remaining differences. One is the fact that Mr. Thompson has what I believe a little aggressive rate of growth of volumes in the railroad business, but as Mr. Thompson himself explains, the railroad business does not contribute too much to the value of Ferrovias. As a consequence, this is a very minor issue. The final point of difference is a discrepancy with Mr. Pratt on what the discount rate ought to be. And again, once you take away the double counting and the unsubstantiated real estate revenues, there is very little difference between the two parties, and therefore the WACC plays a very small role after you clean up these two major problems of double counting and unsubstantiated real estate revenues.
Thank you, Dr. Spiller. Now, you identified double counting as the largest difference. Could you please elaborate for the tribunal?
Yes. Maybe the tribunal will benefit by going to Figure 1 of page 16 of my second report. In essence, the claimants, experts double count damages. Why? Because there is no disagreement between claimants, experts, and me in that the fair market value of Ferrovias ought to be reflecting essentially what a willing buyer and a willing seller will agree on the price for changing ownership over Ferrovias. That's the fair market value of Ferrovias. That's what a willing buyer would have paid just prior to the lesivo for that asset. There's no disagreement on that. Where we disagree on that is on what the value is on that particular fair market value. Claimants, experts attached $30 million to that. I think the company was worth, the equity value was zero. Now, where there is another, a more fundamental, I would say, disagreement, conceptual disagreement, is that claimants, experts add to the fair market value these lost investments, which they value at $42.9 million. Now, in my first report, I pointed that these two concepts, the lost investments and the fair market value, are essentially two ways of trying to approach the same thing, which is, what is the value of these investments? What is the value of Ferrovias? One way you can look at that is by the willing buyer, willing seller standard, which is the more traditional standard. That's, according to them, is $30 million. You could also make the point that if the rate of return, the internal rate of return of this business was in fact the WACC, the weighted average cost of capital, then what they invested in the company brought up at the cost of capital ought to be more or less the same as the value of Ferrovias. And therefore, by adding these two concepts together, you are doubling the damage, the alleged damage. Well, Mr. Thompson agreed that there was double counting in the second report, and therefore he provided a solution to that, or a way to get out of that solution. The way he suggested this can be dealt with was in the following way, by using what he called an amortization. That is, he took the $42.9 million and he amortized that over a period of 42 years. How? By essentially dividing 42.9 by 42. And each one of those amortizations, annual amortizations, he computed the present value of each of those as of 2006. So now, the present value of $1 million, one plus a little bit more in 2007, as of 2006, is not one, is around 850,000. 2008 is 800,000. 2011 is 500,000. And 2048 is essentially zero. So he goes and then sums that up. Summing up those 42 amortizations in present value terms is around, using their WACC, approximately 7.9. In the second column, you see now that if you added to the fair market value the whole lost investment of 42, and then you just deduct 7.9, you still have substantial amount of double counting on the order of 35.1, as you can see in this chart over there. So in the first column, you have full double counting. In the second column, you have more than 4/5 of double counting, because 7.9 is less than 20% of 42.9. So Mr. Thompson, doing this particular artificial accounting, if you wish, adds to the value of Ferrovias 35.1. Now, it is clear that this is overcompensation. Why is that? Because if you are trying to bring claimant to the same position it would have been absent the lesivo, you ought to pay him not more than what claimant could get from selling Ferrovias to a willing buyer. And Mr. Thompson assessed that at 30.1. So any amount addition to 30.1 ought to be, according to this traditional standard of wiping out the consequences of the measures, overcompensation. And they more than double the damage. Is 30, they add 35.1 to 30. As a consequence, there is more than doubling of losses.
Thank you, Dr. Spiller. We've talked about the first major difference between the experts. Now let's talk about the second major difference, projections of real estate revenues, and why you maintain that they are speculative and unsubstantiated.
Okay. I say that Mr. McSwain's estimate of revenues are unsubstantiated. I may want to bring you to figure 5 of my second report. Figure 5 is in page 29 and is presented here in this slide, in this page. Figure 5 starts by looking at the historical performance of Ferrovias concerning real estate operations. As you can see in this chart, Ferrovias, since its beginning, was involved in real estate operations and was able to sell or to lease not more than $500,000 per year. In fact, these columns in gray that you see in this chart until 2006 are real estate operations. There are two types of real estate operations. Leasing of right-of-ways, which approximately is $150,000 a year, and leasing of facilities, which is the Cobigua facility in Puerto Barrios, which is approximately $350,000 a year. So overall, during the pre-lesivo period, real estate operations were relatively flat with no discernible trend at around $500,000, $500,000 per year. Now, in his first report, one additional, if I may, one additional notice, the amount of railway kilometers leased by 2006 were 72.4 kilometers, okay? Which consisted of essentially 4 right-of-way leases, one being the largest at 54 or 52 kilometers, and one minimal of just 18 meters, another one of 1.6 kilometers, in another one of 16 or so kilometers. 72 at $150,000 is around, say, $2,000 a kilometer per year. That's approximately the business of rights of way. Now, in his first report, Mr. Thompson assumed that from 2006 to 2007, Ferrovías will be able to sell $6 million in 2007, and that it will be able to catapult the number of kilometers from 74 kilometers to around 1,200 or 1,400 kilometers in 1 year. I mentioned in my first report that such growth is unheard of, but more than it's essentially unsubstantiated. So in the second report, Mr. McSwain provided a revision in which he provided this type of chart. As you can see, this chart achieves the $6 million, close to $6 million by 2012, and at a rapid growth in leasing as well as in new leasing of facilities, the 22 facilities that they have, as well as in right-of-way. And in essence, Mr. McSwain assumes that by the end of 2012 or so, the whole network, both the main lines and the rural lines, will be leased out completely, having 2 sets of right-of-ways leased, telecommunications, one by telecommunications, one by electricity distributions. Now, the fundamental problem with this second report of Mr. McSwain is still it's unexplained how what Ferrovías was unable to do until 2006, then suddenly it is able to do. Now, normally, when you see when you expect a rapid growth, is because either the market booms, so you expect to grow with the market, but the market in Guatemala for right-of-ways, Mr. McSwain provides no evidence that there is a sudden increase in the market for right-of-ways or for real estate in general, or because you suddenly have a particular asset that you can sell that you didn't have before. So now Apple invents the iPad and captures a huge market of iPad, or Apple invents the iPhone and gets millions sold. There is no innovation here. The innovation, Ferrovías exists since 1998, and it can provide the same services that in 2007 as it can provide in 2001. And the failure of Mike Swain is to provide any substantiation to how this will take place.
Thank you very much, Dr. Spiller.
Are you okay? We can keep to the time. Thank you. Mr. Foster.
Thank you, Mr. President. Good afternoon, Dr. Spiller. I'm Alan Foster, and I represent the claimant, and I'll be asking you a few questions this afternoon. While we're on your figure 5 on page 29, let me just ask you something that might clear up an issue that was brought up before. Looking at your chart, you were talking about the Cobigua lease at Puerto Barrios?
Yes.
And there's no question in your mind that that lease goes beyond 2015, correct?
In fact, in 2015, there is an increase in revenues.
The revenues double in 2015, and the lease keeps going until, how long does it keep going?
My understanding is until the end of the concession, and in figure 5, you see precisely that increase in the lease. As you see, the green bars are my own assessment of growth in the Ferrovias real estate business. And what you see is that the growth until 2015, I project around a 9% growth per year. And then in 2015, it has a jump. That jump comes from precisely the Puerto Barrios going from 2% of Puerto Barrios revenue, or Cobigua revenues from the facility to 4%. And that is perfectly reflected in this chart.
Okay, I'm going to try to sum up our differences with just a few questions. So if I can do that, we'll move right along. If I understand your report correctly, your conclusion concerning fair market value and computing it pursuant to the discounted cash flow method of assessing future cash flows, that methodology would produce the same result whether the expropriation was legal or illegal, correct?
Correct.
Okay, and let me try to do another one for you. I believe I understand correctly that your contention with regard to the amortization issue is that you should gross up the amortized amounts by the weighted average cost of capital when they are subtracted or amortized in the future years, correct?
Well, let's make this very clear. The amortization exercise is unheard of. That is,
that wasn't my question. No, sir.
No,
sir.
No. Because
Mr.
you are
President,
asking,
would you ask him to answer my
You have
question?
to answer what you are asking.
yeah, but he asked me my opinion.
No, I didn't.
You should answer.
Okay,
please
go ahead.
repeat the question so that there is no confusion.
Your argument is that the amortization amounts should be grossed up by the weighted average cost of capital and then subtracted from the future income flows, correct?
No. My argument is that if you are going to perform this particular exercise by which you are first adding the absolute value of the lost investment and then deducting amortization from the cash flows, as Mr. Thompson is doing, then you ought to increase the amortizations by the cost of capital, by the same factor that you are going to compute the present value of those amortizations in the future. Because otherwise, what you are doing is you are distorting the double counting. Because you can't claim that you are eliminating double counting simply by a trick of discounting. So if you are adding something and then forcing that to be depreciated over years, over 42 years, and this is a long period of time, then you ought to take into account, as Ripinski and Williams says, the value of time, because otherwise you are creating, just by pure artifice of discounting, a value that doesn't exist.
I thought the first part of your answer was precisely what I was asking you. That your position is that if you're going to award both the investment and lost profits, that you should gross up the amortization amounts by the time value of money measured by WACC, and thereby eliminate the double counting, correct?
Well, not really. Again, you have to be very precise, because if you are going to add, if the exercise, the tribunal can do whatever it wants in damages, but if an expert is going to add the value of lost investments and then perform a particular amortization over 42 years so as to eliminate any double counting, you have to take into account the fact that, as Ripinski and Williams said, an amortization 10 years in the future is not the same as the money today. So you have to take into account the time value of money. As a consequence, the only way to take into account the time value of money is by increasing the amortization by the same factor that you are going to discount it. In that way, you don't create artificial differences, because, as I show, by simply doing this particular trick, you create double counting.
And by doing your, if you will excuse me in calling it a trick, as you've called my experts, by doing your trick, you eliminate completely the sunk cost or the investment, correct?
No, you eliminate double counting.
No, but don't you eliminate the sunk cost or the investment?
You eliminate the double counting. You can compute your damages based on sunk cost if you wish, and we can discuss that. Or you can compute your damages based on the fair market value. You are fair to do that, and both are legitimate approaches, and we can discuss those. What you cannot do is say, well, I have two ways of measure the value of this apple, and therefore the value of this apple is the sum of these two measures. Or a particular, I get one apple, I take a bite of it, and I sum one bite less, but I am summing on two apples. That you cannot do. Now you can, if you wish, we can discuss whether it's okay to award claimants lost, what they call the lost investment.
And we will.
Or not.
And we will. All I'm trying to make sure that you and I understand each other completely, and that is, if you gross up the amortized amounts, what you end up with is nothing more than the lost profits discounted by the weighted average cost of capital.
Yes, sir.
Okay. Now, let me ask you something else. Suppose I told you, I want you to assume for the purpose of this question, that there are electric company poles and wires over almost the entire right-of-way. Okay?
Okay.
And assume that these are electric companies who can afford to pay $3,200 per kilometer for all of the poles and wires that they've installed on the right-of-way. Got that one?
I got that one.
Okay. And suppose I want you to assume that the tribunal concluded that these electric companies would pay rent but for the issuance of the CBO declaration. Okay?
Okay.
Now, based upon those assumptions, you would have to conclude, would you not, that Mr. McSwain's calculations of real estate income were not speculative?
Oh, not at all, because Mr. McSwain analysis is not based on the fact that he assumes the tribunal will make a determination of fact, such as A, that there are that these individuals will pay, because the fact is that Mr. Maswain doesn't know what the tribunal is going to do. And second, I would say more, the fact is that many of these electricity companies, according to Mr. Sen and Mr. Maswain testimony, were there before the lesivo. And as far as I understand, and Mr. Maswain doesn't say otherwise, these companies are not paying Ferrovias anything. Were not paying before the lesivo. So, in fact, what makes Mr. Maswain even more speculative is that Mr. Maswain says in the second report that absent the lesivo, Ferrovias would have entered into contracts with these utilities. And the question is why Ferrovias didn't enter into contracts before. That's why I say that Maswain is unsubstantiated, because it makes statements that do not fit what the experience of Ferrovias was. If Ferrovias could have entered into a contract, then we should see it. But
I understand your arguments, and you're taking issue with with the assumptions of my hypothetical, and that's fine for you to do that. But if you assume the facts that I have given you in the hypothetical, don't you have to conclude that Mr. Maswain's calculations with regard to real estate revenues are not speculative?
Sure, because how couldn't
Thank you.
I?
Thank
The fact they will remain equally speculative.
Now, I believe I'm correct, am I not, that nowhere in your reports do you identify the standard of compensation that you assert is appropriate for a violation of the fair and equitable treatment standard?
No. I compute damages to Ferrovias from the claim that by issuing the lesivo, the business lost all its value.
But nowhere do you say in your report what you think the appropriate standard of damages is for a violation of the fair and equitable treatment obligation. You're dealing in your report with the expropriation damages, isn't that correct?
I object, Your Honor, Mr. President. It's calling for a legal conclusion.
Well, he spends the large portion of his report talking about what the appropriate standard of damages is when a property is expropriated, and I'm just asking him, is there any place in his report where he makes any assertion about the appropriate standard of damages for a violation of the fair and equitable treatment standard?
Mr. Spiller, you should answer the question.
Yeah, sure. Yeah.
Can you show me where that is in your report, sir?
I don't make a distinction between, from the economic perspective, between expropriation or of a business or an impact via any alternative measure that has the equivalence of destroying a business. From the perspective of the claimant, the loss is the loss.
Thank you, sir. Now, let's talk a little bit about the net cash contribution method. I promised you that I was going to chat with you about that. When do you say that RDC stopped making investments in this case?
RDC continue making investments throughout the period, contributions to Ferrovias throughout the period prior and after the lesivo. And it is, I think these numbers, the amounts that have been put into the company are not necessarily in dispute except for a few $1,000s.
Okay, in your report you say that the NCC approach is appropriate when the expropriation occurs close to the time of the original investment, right?
Correct. And
so
fact,
in this case,
well, if I may,
I'm sorry, I thought you were.
If I may, the NCC, what I don't exactly, I can look at it, what they say, but essentially what I have written on this is that the NCC is appropriate when you have a company that has not yet started operating and is in the period of investment, and prior to starting operating, the company is expropriated or is terminated. In that case, we argue the NCC could be considered because you just can't have a measure of performance. In the case of Ferrovías, you have 8 years of performance. As a consequence, the role of the NCC is substantially diminished because you can see what the company has done through this period, which is fundamental to be able to assess using discounted cash flow the fair market value.
Well, you just told me that RDC had not even completed the investment period yet when the Lesivo occurred.
Well, the problem is that Ferrovías was never able to cover its cost. So because Ferrovías was losing money every year, the claimants provided essentially a subsidy to cover the cost. And in fact, the Ferrovías stopped investing in 2000 or 2001, and from then on, all the contributions that RDC did to Ferrovías was purely to cover operation losses. So it's not that Ferrovías stopped investing. Ferrovías stopped investing quite a while back, but it was unable to cover its cost.
When do you say that Ferrovías stopped investing?
Well, you can look at this in a chart, and you will see that readily. If I have here, look at chart 2, figure 2 in page 21. In page 21, you see capital contributions and fixed asset investment. And you can see that the main investment of Ferrovías was in 1999, in which it invested $6 million plus of US dollars. Then it invested in 2000 a bit less than $500,000. Then in 2001, a little bit less than $500,000. And then in 2002, I would say it's almost nothing. In 2003, 4, and 5, and 6, there is no record in the accounting books of any investments. So the additions to fixed assets that the accounting books show essentially an investment in 99, $6+ million by Ferrovías, and that's it. From then on, it was just the minimum investment in 2000, 2001, or a little bit. Now, you can see also that where the money went from RDC. You can see that in this chart, because in 99, RDC invested or contributed to Ferrovías something like $6.5 million US dollars, which is a little bit more than the fixed asset, but not that much. But from then on, Ferrovías invested less than $500,000, but in 2000, RDC invested more than $1 million. In 2001, almost $2 million. So the difference between the contribution, of RDC and the addition to fixed assets of Ferrovías is to cover the deficit. So it's not that the amounts, the contributions of RDC were to go to adding rail stock or adding improvements in facilities, but rather to cover operating costs.
Mr. President, I know we all want to hear all of Dr. Spiller's views, but I have a very limited time, and I would appreciate it if you would ask him to try to restrain the length of his answer so that I can try to cover at least a few of the points that I'd like to cover with him.
Dr. Spiller, if you can be as succinct as possible. Thank you.
Well,
So if I understand you correctly, Dr. Spiller, let's take a company, as you just said, that had never started business yet, and it was expropriated. And the tribunal thought that it was appropriate to award damages in that case, and they would award damages based upon the discounted value of future cash flows, right?
if the tribunal wants to compute the discounted cash flows, fine.
Okay. Now, their other alternative would not be to use the NCC method because there's been no investment, right?
If there is no investment, there is no NCC.
Now let's take another company that has made a substantial investment but has not yet commenced business. If I understand you correctly, that is the business that you say it is appropriate for the NCC method to be used to value.
Well, you could use the NCC in that case.
Okay. Now, let's take a company that has made a substantial investment and has operated a few years, and for the purposes of this example, let's assume that they've operated a few years profitably. Your position would be that the value of that company is nothing more than the future cash flow.
You will expect if once the company is in operation and you can ascertain what future cash flows are, then a willing buyer will be always a willing buyer bases in future cash flow, always.
So
The question is how sure you are on that.
So by your methodology, the damages would be precisely the same for a company that had made no investment and had not started into business versus a company that had made a substantial investment but had not started into business versus a company that had made a substantial investment and operated a few years. You get the same result, right?
I don't see how it follows. It really depends on what the expectation of the business is.
Well, but assuming that the expectation of all three businesses was the same, you would value them precisely the same way.
If the expectations, if a willing buyer is willing to pay the same for a company in business than for a company not in business, then the two companies are different animals, right? Because a company that is in business already invested has clients. You don't have to perform the investment. A company that has not yet invested in a business, you have to invest, and then you have to capture clients. So the fact that they have two same value means they are different animals, not the same company. One may be a computer company, another a telecommunications company. They both may be valued $100 million. That's okay. But if you have the same asset before investment is one thing, after investment is another thing, because after investment, much of your uncertainty is realized. Now we know what this company is all about. I have a lot more certainty. If the company doesn't exist, it's all in the paper, well, how do I know how much it's worth?
Okay, suppose a company made a very substantial investment and operated for 1 year at a loss and was expropriated. Suppose they made a $100 million investment, they were startup, they operated at a loss for a year and was expropriated. Are you telling us they're worth nothing?
No, it depends again what the expectations of future cash flows are.
Okay.
Say for example, we have a lot of startups. Most startups fail. That's the truth. I come from Berkeley. In the Bay Area, you have startups galore, and none of those remain. So all of them, investors invest, and after a few years, the value disappears. It happens. It happens all the time that you bet. And some bets are good, and some bets are bad. Facebook made a killer, but startup.com lost their shirt. It happens all the time.
So let's suppose you have a company that makes an extremely large investment and operates 2 years, and it's not profitable. Are you telling us that has no value?
Again, it depends on what the expectations of the business is.
So-
if it has great expectations and there is agreement that this is a great business, may have a lot of value. It doesn't. The fact that currently lost 1 year or 2 years is not major evidence. The point is, if you have sustained period of losses, well, that should tell you something about the future. The future cannot be so rosy if this is a company that is unable to attract customers.
But what you're telling us is that the evaluation of the future prospects is a question of judgment based upon all of the evidence, correct?
Based on the evidence,
Okay,
always
thank you.
based on the evidence.
Okay, thank you. Now, let me ask you a little bit about the weighted average cost of capital, and in particular, I want to talk to you about the cost of debt. You have used a cost of debt of something over 18%, correct?
Correct.
And the only example you give of debt in Guatemala where FVG borrowed money was one loan that was at 16%, correct?
Well, that's one loan. There are other loans that early on in 99, 98, which were out 22, 23%.
You don't give any of those examples in your report, do you, sir?
They are in the record. It's in the annual reports of 98, 99.
You didn't consider them important enough to cite them in your report, though, did you, sir?
Well, they are in the record.
Did you consider what kind of loan that one loan at 16% was?
Well, the 16% is actually a collateralized loan.
It was
so that it was a loan for a pickup truck, collateralized on the pickup truck. Normally, collateral loans are cheaper than non-collateralized. You can add to that a 3-4% for the risk of failure. So easily, if you are getting a loan at 16%, means that your cost of debt without collateral should be 18, 19, 20%. And therefore, that shows in the first annual reports, in the 99, 98, 99, and I think in the 2000, you can see loans that RDC issue between 20 and 23%.
You know that you've said it was a collateralized loan and it was a pickup truck. It was a $15,900 loan for a used pickup truck. Isn't that right?
I don't know if it was used.
And are you telling the tribunal that that you're asserting that used car loans, the interest rates on used car loans, whether they're collateralized or not, are higher than business loans? I mean, are lower than business loans, I'm sorry?
Well, it is
That's not your experience, is it, sir?
Excuse me, counsel. Essentially, whether a company takes a loan or not depends on whether it can get easier access to capital. That's the fact. If you can get a loan cheaper than 16%, you'll get it.
And indeed, in this case...
Excuse me.
Oh, you weren't done?
No, not done.
It
In
doesn't
this
surprise me,
case,
but
in this case, Ferrovias is a company which, given its lack of profitability, given that the accountant, the audit statement says that every year that the future is uncertain since its losses may exceed more than the legal limit of 60-something%. To issue loans under those circumstances are very difficult, very difficult. So we assess the cost of capital, the cost of loan, the cost of debt based on the standard, which is to look at a company which will be rated C, to look at the margins for a rated C company, and the margins essentially give you a loan, a cost of debt of approximately 15%, 16%, to which you add the country risk, which is around 2% or less. You are into 18.5%, 19%.
Yes, sir, if you could just try to restrain yourself, I'd appreciate it. Let me ask you just a little bit about the size premium issue. You've used the 10B decile, and Dr. Pratt used the 10 decile in its entirety, correct?
That's correct, yes.
And you would agree with me that the 10th decile in its entirety includes the 10B decile figures?
Yes, and it includes companies which are many, many times larger than Ferrovias. If you look at the companies in the 10 decile, you have companies which are 10 or more larger than Ferrovias in market capitalization. According to Mr. Thompson, the market capitalization, absent LSE, was 30 million. This is 30.
Say that last phrase again.
It's 30 million. Now, in 10B, you have companies that size. In 10, you have companies way above 300 million. So it is very risky to compare the size premium for a company that claimants value is 30 as attached companies that is large. In any case, the companies within 10 are also, companies within 10B are also within 10, so some of the companies there are small, some are in financial trouble. It's a mixed bag.
Now, another area that you and Mr. Thompson have disagreed upon is the relative weighting between the real estate side and the railroad side, correct?
Well, it's not that we disagree, really, because it's not Mr. Thompson. This is with Mr. Pratt. Both
I'm sorry,
of us,
I meant Dr. Pratt.
Yeah, Dr. Pratt and I apply the same method. We take the size of each relative business. You see, the size, in my case, you have essentially the two contribute approximately the same. Railroads, in my case, contribute more revenue, 2/3 of the revenue. In Mr. Thompson, it contributes 90% of the revenue. So Mr. Pratt takes essentially the same approach. Well, how big each business is, I attach that as the weight. So there is not a conceptual difference. The only conceptual difference we have with Mr. Pratt is the size premium, which we just discussed, and the cost of debt, which Mr. Pratt uses 7%.
In any event, though, you disagreed on the appropriate weighting, correct?
Well, it's a natural disagreement. It's not a conceptual disagreement.
Isn't the answer to my question yes?
Yeah, but it's a result of the other work. It's not that I have an issue with the weighting. It's that the weighting results naturally from the rest of the work. It's not a conceptual disagreement with Mr. Pratt, because claimants have higher value and higher revenues for real estate. Naturally, you create a higher weight on real estate.
And that was based upon Mr. McSwain's projections with regard to real estate revenues, right?
Correct, exactly.
And if the tribunal were to decide that his projections with regard to real estate revenues were appropriate to be used in this case, then the natural result of that would be that the weighting that Dr. Pratt uses would be the appropriate one,
Exactly, correct, yes,
Okay.
absolutely.
Thank you. I don't have any more questions.
Thank you, Mr. Foster. Mr. De Bois.
Thank you, Mr. President. Dr. Spiller, I wasn't going to bring you into this, but since the claimant counsel asked you a question about it, they were trying to drag you into the legal discussion about illegal versus illegal. I think they have some notion that there is.
I thought he was going to ask a question.
I'm going to ask the question if you'll permit me.
I object to the editorializing, then please just have him ask a question.
All right. Dr. Spiller, the Chorzo factory case contains several questions, 1A, B, 2. Is it your understanding that those questions take care of any possible incentive that a country might have to engage in a frivolous expropriation?
Well, the Chorzo the doctrine, and I have written on that actually, but the logical rationale for the Chorzo doctrine is precisely that by looking at the value of the enterprise as of the date of the award, rather than as of the date of expropriation, you may capture increasing value of the enterprise from the time of the taking to the time of the award. And therefore, if a government attempts to expropriate a business who is having a rapid increase in value, this component of Chorzo will take care of that.
Thank you.
Can I make a minor but very important point? It's pronounced Horzów.
If one can do that.
Pronounced as the Poles would pronounce it.
We apologize to the Poles. We're here in the Western Hemisphere and obviously not educated enough to be able to pronounce that.
I haven't given up even on the United States.
Thank you. I think I have no further questions.
Whether Professor Crawford has any further questions beyond instructing us how to pronounce it.
I very much appreciate your professionalism, and I'm trying to ask questions that will help illuminate for me some of your assumptions. In assessing if there are to be damages, and that's obviously a separate issue, but if there are to be damages, are you essentially assuming that the actual revenues from 2000 to 2006 from the transmission lines and so forth, as well as the industrial part, the two pieces that you described as being the exploitations of the rights of way, would not have increased at all? Or did you make assumptions that they would increase but at a lesser rate than McSwain and Thompson?
I essentially adopt McSwain's assumptions about the existing contracts. The existing contracts, some are for 20 years. For example, I think the Genor contract is for 20 years. I think the Texaco also is for 20 years. McSwain assumes they will be renewed, and I also assume that. That is, I take McSwain's assumptions and assessments about the existing contracts as they are.
Yes, sir. That I understand. I understand that that your chart on. May I address this to you, please? Page 29, Figure 5.
Yes.
You explained to us that you assume a 9% growth rate in 2015, and then because of this one large contract, the growth. So I understand that the green part of the bar is actual contracts projected out.
Exactly.
What I'm asking, please, is are you assuming with respect to the red, that is additional easement contracts, and the blue, additional commercial leases, are you, in your assumption of damages, are you assuming there would have been no additional easement contracts and no additional commercial leases?
Right.
And why do you make that assumption that between now and 2025, let alone 2042, there wouldn't have been one
Right.
easement, not one lease? I'm trying to understand
Right.
your thinking, please, on that.
Yeah, no, what I have done is look at the evidence that Max Swain provided. And the evidence that Max Swain provided is simply not convincing in terms of, well, what do I base to add contracts? Max Swain has failed to explain to me, and probably to you as well, in my mind, why is that a company that failed to capture a single new client since 2000, the contract in 2001 is for $500 a year, so you can forget about that, that failed to capture a single customer since 2000 suddenly can capture new clients. There is no explanation of what was the reason. And because in both of his reports he has no explanation of what was the reason, my inference is that he doesn't have one. And if he doesn't have an explanation to why Ferrovías was unable to lease, then my sense is that it can't, because there is no demand, others can use it, there is plenty of supply. That's the problem.
Let me ask you if there's anything between the devil and the deep blue sea here. That is, even if you assume that Mr. McSwain's estimates are overly optimistic, is there not some likelihood that there would have been some leases and easements during this entire period?
There is a likelihood, but there is no evidence on A, what will they be, on what terms will they be, for how long will they be. There is no analysis in McSwain of the competition. There is no analysis of what other sources of right-of-way, for example, or other facilities are out there that compete. McSwain has no analysis of the market for right-of-way.
Now, one of the things that we've heard, and we have to judge in the end whether this is something we give credence to or not, is that the allegations are made by the railroad that part of the problem they had was the alleged failure, I underscore alleged failure, of the government to pay several $1 million into the trust fund, which would enable the railroad to be rehabilitated to a greater degree. And they allege that the government failed to remove squatters and that impeded their capacity to operate. If you assume that those allegations are well-founded, and again, we haven't made that judgment yet at all, would that affect your view of what a willing buyer and willing seller would have provided? In other words, one of the reasons that you say that there was no value at all, that a willing buyer would have paid zero, is because you look at the record and you say, well, there's no profit. If you assume that the government itself, as they allege, is partly responsible for that because of the squatter issue and the failure to pay into the trust fund, would that affect your view of fair market value?
Okay, one qualification, and I will answer your question. The reason why I assess zero value is not because in the past they had zero profits, but rather because you don't see a business growing. You don't see a business that is on the verge of success. In other words, you don't see this mountain coming in here. In fact, in the company, my forecast will start making money down the road. Okay, so it will, but that's a minor issue. Let's take the FEGWA contributions to the trust fund. I think this is an important issue to clarify because my understanding is that these contributions were between $300,000 to $400,000 a year. Okay, these are not contributions that make any difference in the value of the company. That is, claimants claim the value of the company is $30 million. If FEGWA failed to provide $300,000, $400,000 a year, will barely change the analysis. It could have then facilitated RDC, would not have to make some contributions. As I show you, RDC made contributions of $300 million, $1.5 million, every year, would have reduced those contributions a little bit. Nothing would have changed for Ferrovías, nothing. So, so the same reason why neither Thomson looks at those values nor McSwain looks. Essentially, you can, my opinion is that it's a red herring, it's a contractual dispute, it's fine, at the end of the day, $3 million, it's not peanuts, it's an issue. But it's not at the core of the dispute in terms of value between claimants, experts, and me.
Squatter issue?
The squatter issue is interesting because the squatter issue raises a fundamental issue of value. That is, if you're a squatter, and let's talk about the industrial squatters, which are easier to deal with than with the civilians, housing squatters. Those are more complicated. But the industrial squatters are people who benefit. Well, everybody benefits, but these people benefit, I would say, a little bit more. And they, in principle, could pay, right? They could pay. So then you have to ask the question, why the squatters were not paying before? That is, Mr. McSwain provides evidence that there was something like 460 kilometers of railway use by industrial squatters. And the first question you have to ask is, why was that FEG fail to enter into a contract with them? And what is so interesting is that Mr. McSwain says, in the absence of the Lesivo, FVG would have entered into contracts with them. And I don't see the reason. That is, if they didn't enter into contract by 2006, what was the reason they didn't enter? Well, maybe because, it was not that worth for them to pay $2,000 or $3,000 per kilometer a year. Why is not? Well, there may be maybe substitutes or other ways by which they could get the service. Or maybe we really don't know, you see, and unless I have evidence, substantive evidence, that these people will not move away if they had to pay. And also we have the problem of the squatters, were they there before or they came afterwards? There is some, in the record for me, some lack of understanding about that. But some may have come afterwards, and they may have afterwards because Ferrovías was not operating, and therefore they don't pay, zero price, but they didn't come before and in contract with Ferrovia because they had to pay a price. So it's kind of reflecting willingness to pay. You see, if you drink Coke when they give you in a party, but you don't buy Coke, means that you don't like Coke that much. So there is a willingness to pay issue here that needs to be addressed. So the squatters is, I think it's an interesting problem, but to me it doesn't give me an answer to know that Ferrovia's network has been used, because the fundamental question is, well, if it is being used and people are willing to pay, probably you should have entered into contract, because companies don't like to be in a precarious situation. If these poles and transmission lines are complicated business, and if I have to remove them, it's going to cost me a lot of money, and I risk that, then maybe I should enter into a contract and pay Ferrovias a little bit of money. But if my alternative is to take them elsewhere, who knows, highways or whatever, and not pay or pay very little, then I don't want to pay $3,200 per kilometer. So the evidence, the problem in the record is that claimants have not made a case, a sufficient case, I believe, that this is property that has the value that is being assessed.
I understand your point about free goods. I would suggest, since I chair the International Advisory Board of Coca-Cola, I would drink as much Coca-Cola if I have to pay for it as I get it free. Maybe you'll use another example in the future. What about the companies that can't move? They've sunk an investment in now. There are apparently some of those. How do you take that into account?
Well, again, the question is whether this came before or after, right? That is, if they came after, they came because it's zero price. And the question is why they didn't come before and pay Ferrovias. Well, then that decision itself tells you willingness to pay. If they came before the lesivo, the question is why they didn't enter into a contract with Ferrovias. What prevented that? Now, there are two potential explanations for that. One is that they say, well, maybe no one will evict me, and I have all the bargaining power. No one will evict me, because no one will evict me. Then they will never pay. The other is because I don't care if I'm being evicted. If I'm being evicted, I'll just go elsewhere and put my lines elsewhere, but I'm not going to pay the $3,200 per kilometer per year. So one needs to understand what is the reason by which these industrial squatters were, or why, let's put it in this way, why is it that Ferrovias was unable to reach an understanding with them? That's the evidence that is missing in this record. That is, if I will have to make my claim based on the fact that here is the squatters, I should get money from them, I have to explain to you why I have been unable to do that. And in the record, I don't find that convincing explanation.
You suggested that you could use either in assessing damage a sunk cost assumption or a fair market value assumption, but not both. That's the thrust of what I understand you to say. Is that correct?
Yes, sir.
From the tribunal standpoint, illuminate for us which you think is the most appropriate. Obviously, you're arguing against combining. But as I understand it, the fair market value assumption, you come up with zero, in fact, less than zero, right?
Correct.
So they would have invested $15 million and they get nothing. Under the sunk cost, what is your calculation?
I didn't perform that calculation, okay, because essentially my assessment is that there is no evidence that this company is a viable company. In other words, this is a bad, and I believe Mr. Posner stated that in some of his own writings, that this is a bad company or a bad investment. But that may be as it may. I think that claimants' experts also will agree that the appropriate approach is the fair market value, and for the following reason. If you look at their assessment, they compute the fair market value at $30.1 million, and they compute the lost investment at $42.9 million. It cannot be that the value of lost investment exceeds the value of the enterprise. That is, you can never lose more than what you assess the company is. So at some point, your investments went bad. So the fact that they assess the value of the investments, because the nominal value is what you said, 15, 16 million, right? But by accumulating at the cost of capital, which they claim is 12.9, they get 42.9 million. But that cannot be higher than what the company is worth, because if the company is worth less than their computation of loss of investment, is that the rate of return cannot be that high. This company would not be covering its cost of capital. That's why it's 30.1 and not 42. So they will also agree that lost investment, as they computed, overstates value.
But I appreciate that. I'm trying to ask perhaps a slightly different question. We have a company that I think, as you say, the facts pretty much established that they contributed about a little over $15 million. If one assumes, and again, we certainly haven't come to that determination, that the declaration of Lesivo was inappropriate, that there was an inappropriate action by the state, would you say then, in your calculation, that the claimant would have proved its case but would be entitled to nothing?
Well, that happens too, right? That is, it happens often that you have a bad investment, and this is a way to get out. That is bad luck, and you are out of it.
But that's not the assumption. I'm asking you to assume, again, stressing we haven't made this judgment at all, but that if one assumes that the government of Guatemala acted inappropriately in canceling the contract on the grounds that they did, are you suggesting that having invested $15 million that the railway should get nothing? Or under those circumstances, would you say they should get something and here's how I would calculate it?
Well, I think the appropriate way to compensate in this case, when 8 years has passed since the company started operations, when operational improvements have taken place, safety improved dramatically, cost went down. The company did as much as it can do, but there is a fundamental problem of demand. The demand just is not there. Then you know this railroad is not going to make money. Even Mr. Thompson says that the railroad only side of the business is worth not more than $1.5 million. So even Mr. Thompson agrees that the railroad is not really there as a substantive issue. So everything else is things in the sky. That is, well, I could sell this, I could sell that, but in reality, it's not there. So if you wish to say, well, the business, claimants say the business, the real business, will never collect more than $1.5 million, and we assess the railroad at less than $1.5 million, not, and essentially also at a negative value, but it's about business.
No, I understand. We have to, again, make a judgment about whether these projections are overly speculative and what they could do. I'm asking, please, a different question. I'm asking, you're suggesting that even under that assumption, that it was just, they were never going to become profitable, if there was a finding by the tribunal that the government acted inappropriately in terminating the contract or in declaring Lesivo, again, we haven't made that, but if you assume that, are you suggesting that there's no way in which you think the railway should get back its initial investment, or at least its investment projected forward?
As an
that it would be entitled.
As an economist, I'm here as an economist, as an expert economist. not a lawyer. I'm not going to add to you assessment of fairness or not fairness. I'm going to give you my professional opinion. And my professional opinion is that if the business was not a viable business and it got expropriated, then compensation should be zero.
So this is where this notion that you have, which is a perfectly legitimate argument, I understand your point, that there should be no difference in, from an economic standpoint, of a legal and an illegal expropriation. It's a bad business, but you're basically saying that from your perspective, if the expropriation is illegal, that there should be no difference in our tribunal's view than if it had been a perfectly legal expropriation. The two sides get together and they decide that we're taking this over for a right-of-way or whatever, and it's done in a perfectly legal way, that from your standpoint there shouldn't be any difference at all in how one calculates the damages.
If I may, just before telling you that you're right, but before just one preamble. The way I like to look at this in general is to assess damages in the following way, is to really put the claimant in the same situation it would be absent the lesivo. And I think this is the fairest way to deal with it. It's not, well, we have to give them money because we have to give them. No, the fairest way is to put the claimant in the position it would have been absent the lesivo. Absent the lesivo, claimants have a business that is, in my professional opinion, is not viable. We disagree with the other side, but I believe that Mr. Thompson, at the end of the day, will agree with me that this is not a viable business. A business that even Mr. Thompson's assessed railroads at $1 million, $1.5 million, it's not a viable business. Long-term investment of 50 years worth $1 million, it's not. So we both agree it's a business that is, well, in my professional opinion, it's a business that is not worth.
Yes, but
then expropriating it takes a problem out of their hands.
But remember that you agree, and I think the other witnesses do, that the real value of this enterprise, to the extent there is a value, is on the real estate side, not on the operations side.
The real value in Mr. McSwain's assessment. And the problem with Mr. McSwain is that, in my opinion, is highly unsubstantiated. And that's my personal opinion. There is nothing in the record that can provide that evidence.
One last thing, and I appreciate it again, is this chart, figure 5. You're again assuming only that the real estate value comes from the existing contracts and that there would be no additional leases or easement contracts. That's your assumption.
Right. I only take those contracts that McSwain was able to show that have validity.
Okay, that's very helpful in illuminating your viewpoint. Thank you.
If I can just make an observation, you might have a situation in which the wrongful act on the part of the state was such that the quantum of damages was not what would put the claimant in the position if the act had not been committed, but what would put the claimant in the position if the investment had not been made.
That's a different standard. Yeah, it's very good.
There may be situations, I'm not saying this is one of them, where that would be the appropriate balance. You would say, in effect, the behaviour of the state has pulled the rug out from under the investment, and therefore it's inappropriate to treat the claimant as having assumed any risk.
I think, Professor Crawford, that's a very good and interesting problem, because in the absence, if the contract should not have been signed, in a sense, and in a sense you could say, well, somehow claimant entered into a contract without knowing exactly what it was, and it was an illegal contract, should not have been signed, this and that, then you are going to revert the claimant to the position it would have been in 97, then it would be $15 million better off, because it would not have made those $15 million investment. So it's not the fair market value issue any longer.
That you were in a situation in which you would say, I mean, if there was fraud in the making of the contract or something like that, ab initio, and 8 years have passed, 15 million has been expended. What would you do to adjust that 15 million to put the claimant in the position that it would be in if the investment had not been made? Do you simply take the cash value, 15 million, and ignore time value of money, or what do you do?
Well, in that case, you cannot use the cost of capital as we have done here, because there would not be any risk associated with the 15 million. So probably you will have to use some risk-free, short-term rates, LIBOR, so on. Obviously, because both Mr. Pratt and I take into account the industry risk, so you have to take that out, because it will not be appropriate to compensate for a risk that would not have been there. So it will be like that, yeah.
Let me just ask, I'm sorry, one other question that I had. And I think you said this was not as crucial as the other points you've made, but this is on this average cost of capital using the assumption of 18%. I think that's the
cost of debt?
Cost of debt. RDC, as I understand it, is a large company, the owner of RVG, that has railway operations around the world. Would it not be a reasonable assumption to assume that they would borrow at the lowest rate they could get worldwide? They would, in using the Guatemalan rate with the risk factor and the other C-rated company, that we should really be looking instead at what RDC could borrow at and what indeed it does borrow at around the world for its various enterprises. Is that a reasonable
No,
thing?
No. And in fact, Mr. Pratt calls it one of the main errors in valuation. And in valuation, you have to look at the cost of capital of the target company, the company you're going to acquire. So if you're looking at the fair market value of something, you look at the target fair market value of the target, you look at the cost of capital of the target, because if you are giving a loan to the target at lower than the target can collect, you are giving a subsidy, and a subsidy has a cost. In other words, you, the shareholder, are taking an additional risk by giving a subsidized rate. So in a sense, if you're a C-rated company, your cost of capital in Guatemala, your cost of debt in Guatemala will be 18. Why 18 and no 7? Well, because that's the cost of failure for a C company. Yep. And if you are giving a 7, you are essentially taking a risk of 11% on addition of the normal risk. That's why you always have to look in valuation at the cost of debt of the target.
But when you look at the cost of the target, I mean, here the target is a wholly owned company of a major multinational company. It's not just a standalone enterprise, and indeed you mentioned yourself that RDC was funding the operation. So you wouldn't distinguish between a target being a standalone Guatemalan company and one that's wholly owned and itself sustained by an A-rated company?
That's an excellent question.
I'm glad I finally asked one that you
No, this is a series of excellent questions you wish, but because fundamentally, when you look at fair market value, you are making the assessment of a willing buyer, willing seller. So you're looking at it as if you were going to sell the company at this moment, how much someone will pay for it. And when someone looks at it, it will pay for it independently of whether you are a fully owned, the target is a fully owned, or is a diversified shareholding. It looks at it as a target, as a project. And different projects always have different cost of capital, and they always depend on the risk, independently of who's the owner. For example, let's say that the buyer will be Facebook. Well, Facebook has a cost of capital completely independent of railroad business. Will it value railroad in Guatemala with the cost of capital of a software company? No. It will use the cost of capital of a railroad company in Guatemala. So it's always, as Mr. Pratt calls it, the basic flaw in valuation, to value a company with your own cost of capital rather than with its cost of capital. So it's fundamental to use the cost of capital of the company you are valuing.
Mr. President, I've figuratively and literally exhausted my questions.
Mr. De Bois.
I have no further questions for the witness.
Nothing from us.
You said it before I asked. I can see that. Dr. Spieler, thank you so much for being with us this afternoon. Thank you.